Ladies and gentlemen, our next session is based on Financial Deepening Indicators for India. हमारा अगला सत्र आधारित है भारत के लिए वित्तीय गहनता संकेतक पर और इसके लिए हमारे बहुत से एक्सपर्ट्स इस समय हमारे बीच में हैं. Ladies and gentlemen, we have the valuable presence of Mr. Lokesh Krishna, General Manager, FGMO Bank of India. Meanwhile, our stage is getting set up. Let me introduce with all our panelists here. Ladies and gentlemen, Mr. Lokesh Krishna, General Manager, FGMO Bank of India. Over 32 years of expertise in diverse banking sectors, including retail, agriculture, MSME advances, and treasury management. He is a certified anti-money laundering specialist and holds certification in advanced wealth management, IT, and cyber security. Ladies and gentlemen, for this session, we will also be having Mr. K. Pramod Reddy, Chairman, Chaitanya Godavari Gramin Bank. He was served as General Manager at Union Bank of India, where he managed critical departments like deposit, mobilization, and recovery, and led the regional operations in Telangana and Tamil Nadu. He is known for his innovative approach, including his role as project head of the lead management system and his contribution in drafting the recovery policy 2024. I request Mr. Lokesh Krishna, General Manager, FGMO Bank of India, to kindly join us on the stage. At the same time, I request Mr. K. Pramod Reddy, Chairman, Chaitanya Godavari Gramin Bank, to kindly join us. Ladies and gentlemen, for this session, we also have Mr. Manoj Pasangha, Deputy Chief Executive Officer, IIFL, Samasta Finance Limited. He has multi-industry work experience ranging from the Australian News Corp to NCIT Airlines. He served as Executive Vice President and COO SZ of Bharat Financial Inclusion Limited, which is the country's first publicly listed MFI. He was the Vice Chairman of AKMI, that is Association of Microfinance Institution of Karnataka. May I now please invite Mr. Rahul Johri, Chairman, Vector Finance Private Limited, to kindly join us for this session on stage. Welcome you, sir. He has been in financial services for more than 33 years, out of which for more than 30 years was in leadership positions across banks such as Bandhan Bank, DBS Bank, Standard Chartered Bank, and ANZ Greenlace Bank. He has worked in various facets of banking like strategic business planning, management of retail business, distribution planning and management, operations and customer service. And with this, now I request Dr. Gursharan Dhanjal, Vice Chairman, SKOCH Group, to kindly moderate this session, to kindly be on the dais and moderate this session. Dr. Gursharan Dhanjal, Vice Chairman, SKOCH.
Good afternoon, everyone. So welcome to this session on financial deepening. When we talk about financial deepening, it has many connotations. So we need to understand and put this in the right perspective so that the discussion that we have, is pointed and remains focused. So we understand that, this is to do with the various facets of the financial sector accompanying financial development. Financial deepening is also about the financial development relative to the economy. So there are certain indicators, I'll come to that. And as the size of the economy increases, as the scope of the economy increases, as the access to the financial system in the country increases, it leads to financial deepening. So having said this, it's important that we understand that it relates with growth and diversification of countries' financial assets and financial markets. Various stakeholders are there in the financial markets. It includes banks, it includes MFIs, it includes NBFCs, market players, asset management companies, insurance for that matter. Almost everyone is an equal participant in this. So financial deepening is about the products becoming widespread, proliferate, and include more and more people into the financial ambit. So it remains critical to see this happen so that the economic growth continues to happen. When we talk about insurance, it used to be in single digit just about a few years ago, whether it is life, health, or general. It has now on the double digits and growing rapidly. More and more lives are saved. Higher number of credit is being given. More and more livelihood opportunities are being created. And particularly at that level, when we say the products which are micro, because the large products you and I possibly can afford, but we do not represent India. India is represented by people who have micro savings, micro insurance, and micro products. So that's exactly where we talk about financial deepening. So we have looked at various indicators. It includes insurance, private sector credit. The list is there in front of you. So we divide it in two parts. One is financial institutions, which is mutual funds, pensions, insurance, and private sector credit. And then we have the market participation, which is the stock markets, capitalization, so to say, stocks traded on a daily basis. Everyone knows that India used to be only one exchange till about 2003 before the formation of National Stock Exchange. And this was also a community of traders. It was not an institution. It was not a corporate body or entity. But Indian stock markets today are well advanced, fastest in terms of the trades that happen in a day. T+2 has already become a reality. T+0 is what we are heading towards. And more people are now investing in mutual funds as well as have become retail investors and trying to reap the benefit of deepening. So there are weightages, which is what we have given. So mutual fund, pension funds, so this is the kind of weightage when we constructed the financial deepening index, looking at the contributions made by various industries. So we looked at AMFI, we looked at PFRDA, we looked at IRDI, RBI, and MOSPI. And put together, we came up with this. And the result was that if in 2013-14, the financial deepening score was 19.71. It has reached 32.20 in 2021. It is at 31.85. It's fluctuating. Let's not look at the drop of 1 point. Let's look at from where it was and where we have reached today. There is a long way to go. Not that this is the end of the road that we have traveled, but yes, moving forward, there is a lot more that needs to be done. We also looked at the credit outreach gap. This was 94.91% in 2001. And look at where it has reached, 74.03. Meaning to say there is a continuous penetration of credit. The gap is reducing. So there has been a decrease of 12.01 in 2022 from 2015. So that's a good news for us. But the point is, this is only part of the road that we have traveled. Now, the good question is that where do we go from here? So that's precisely what the subject of the discussion that we have today, and that we have a cross-section of panel, different stakeholders coming from different walks of life, talking about it. So while it actually says that this is about the penetration of the products, but the point is we have traveled a long way. How do we accelerate it? What do we need to do? Because it has taken us 20 years from where we were and where we are today. We don't have another 20 years to spend. So let me start from the extreme right of the panel. And one by one, quickly, let's spend 1 to 2 minutes and give our sense to it. Then we'll move on from there.
When one looks at financial deepening, I think there are 4 pillars that one looks at. The first one is around saving and transacting capability. The second is around investment and financial planning. The third is around credit. The fourth is around risk mitigation. And then again, when we look at this, we can actually break the pie up between what we could segment in terms of segments, mass market and HNI, and then we look at financially excluded households separately. I think with my experience as a microfinance professional, let me touch upon the second part, the segment that I alluded to, which is the financially excluded segment, which accounts for almost 70% of this population. So anything that one can do over there can have a meaningful impact in terms of financial deepening. Now, again, if we were to approach this as a business, there are 3 points that we need to look at. We need to look at distribution capability, products, and pricing. And there is work that can be done on each one of these. There is work which is happening both in terms of customized and specialized products being done for this particular part of the population. And work is underway. I think clearly the work has started. Leveraging technology or digitization, again, has a big role to play in terms of financial deepening within the financially excluded population. And that is, again, work in progress.
So adding on to what the moderator had started off by saying, that's about a couple of decades since this whole concept of financial inclusion, this whole concept of going out to the hinterlands of the society and seeing how we can get the banking, their needs as well addressed. In 20 years, we may have achieved a fair bit. But if you look at our credit penetration, if you look at the private sector credit to GDP, which is a significant indicator to see how deep and how active a banking system is offering formal credit, we are at around 56%. So there is, whilst it is fantastic, because all this has primarily happened over the last couple of decades, we still have a long way to go. The banking access, credit part of it is one part. The credit access to the people out there is one part of the story. The other important thing is the banking access itself. It's only maybe about a few years since we had this Prime Minister's Jandan, the Jandan accounts. Fantastic. I don't think any country in the world can boast of opening that many bank accounts for its population. Having said that, we cover about 53 crore odd population. So the banking access is there for them. Question to be addressed is, are all these people using it? Statistics says it's about 70% of those accounts are actually active. With that comes the savings mobilization part of it. Gone are the days when in the villages, it was famously known that when the lady wanted to save something, she used to take a fistful of rice from her daily ration and set it aside. And that's the saving for a rainy day. We've now gone to the actual savings. That also, India has made significant strides. Is that enough? Like how I told in the previous question, I said, let us stop looking at the glass being half full and see what we can address for the remaining portion of the glass. Insurance penetration. We have made fantastic progress. Yes, you're right. We have made a lot of progress. But in a country like ours where social security isn't exactly 100%, all the more reason for us to focus a bit more on insurance premium, insurance penetration. And when I say insurance penetration, it's important to see how we can get that insurance out to the masses at affordable premiums, because the bulk of our population cannot afford the rate of premium at which it is being peddled at this moment. Finally, the financial literacy. The financial literacy part of it is another important thing. When you speak about microfinance in particular, most of these customers are simple people. Over 90% of these borrowers are simple, uneducated women. It is imperative for the microfinance institutions and other formal lending sectors who are addressing this segment to give that financial literacy to the women before they offer credit to them. That's it from it.
Trinity.
First of all, let me thank SKOCH Group for giving this opportunity to be a part of this panel. Yes, as seen from the statistics, the last 20 years there has been a considerable progress, but the way forward still long way to go. So all the government has taken very good initiatives for the last 20 years, especially in the last 10 years. The Jan Dhan has been a major game changer in financial deepening. Almost like 53 crores of accounts got added, and people have come into the formal banking financial system now. So going forward, how do we make use of this achievement in the days to come to fulfill the contribution to the economic development of the country? So now in the last COVID, there is a dip of 1% we have seen. Probably it could be during the period of COVID there was additional liquidity available in the system, so that has slowed up. So I think now again after the COVID, the digitization has played a major role, and this is going to create a major change in the days to come. And we should ensure that all these 53 lakh customers who have been added, they will have to join the mainstream in further deepening of the financial inclusion. So in the days to come, I think this digital platform are definitely going to play a major role for further financial deepening.
Mr. Lokesh.
Thank you, and good afternoon all. And I'm slightly critical, and whatever data has been shown, okay, we are moving in the right direction. And whenever you see the data, last 10 years we have financial inclusion and financial percolation, opening of financial institutions, and opening of more products, offering of more products to the customers and the public, and then more services to the public. Is still a long way to go. You can see credit to GDP ratio. If you compare ourselves with China, China is having 150%, and we are having only 55%, 56%. Long way to go. But we have moved ahead. We have moved ahead in last 10 years from 50% to 56%. I was seeing the data, and financial deepening, whatever sir was telling, and whatever is required, that a spread of institutions, financial institutions, opening of more institutions, financial institutions, offering more products, and these services, whatever services you are offering, then this credit to GDP ratio will increase. Certainly it will. It has increased in last 10 years. Financial inclusion increased, PM, JDY or whatever offering we are doing. Insurance segment. Insurance, it has come to the double digit. But if you compare ourselves with the other countries, even developed countries, it has got around 99% percolation down the line. And we are having 10% of insurance, percolation of 10% insurance down the line to the public. It requires a long way to go, but we are moving in the right direction. 2-3, this index I will just share. Credit to GDP ratio I have just shared. Market capitalization to GDP. It is still a long way to go. But we have moved ahead, and now we are nearing 100% of GDP. Market capitalization of the GDP, we are nearing 100%. Then banking penetration. Banking penetration is still a long way to go. Still we are, whenever we are attending SLBC or we are attending other convention, that more branches to be opened. More, this 1,000 per 1,000 people or per 500 people, at least one branch to be opened. Still we are not able to cater 1,000 people per branch, not able to cater. And unless government thinks of this opening of this banking segment to privatization or other segment, more branches are opened, more services are offered. Then if you are opening more branches, more services will be offered. More services are offered, more products will be offered. More competition will come. And here you will see that credit cost will go down. So in my opinion, long way to go. We have moved ahead, but if we compare ourselves with other countries which are peers to us, we have a lot of room, scope is there, and we have to move ahead. And 2-3 lines I will just tell. We have made significant strides in financial deepening over the last few decades. However, driven by reforms in the banking sector, it has happened only due to reforms in the banking segment. The rise of digital payment, UPI, we are doing fantastic. But if you want to move ahead, please link all these payment, all these credit to UPI, mobile. Even the small unliterate, illiterate people working in the villages, people living in the villages, remote places, they are using their mobiles. And until unless you are linking all these credit facilities to UPI or mobile, this penetration will not improve or percolate down the line to 100%. This is my opinion. And one, two more point. There is still considerable potential for growth. Lot of potential available for the growth, especially in credit markets, corporate bond market also. Lot of scope is there. And insurance penetration. I already said the data, it has come to double digit. We are happy with the double digit, but we need to match the other developing countries, developed countries. If you want to be developed countries by 2047, you have to make it, any circumstance, you have to make it 100% penetration of insurance to 100%. Then continued reforms and innovations is required, and but we are moving in the right direction. We are percolating services or institution or products we are offering. Government is serious enough for that, and certainly in moving ahead in next 20 years or 15 years, 10 years, certainly this index which has improved up to 31%, 32%, it will be around 70%, 75%, or more or less nearing the 100% digit. Thank you, sir.
You rightly said that when it comes to financial inclusion, very important element of financial deepening, wherein you have to reach out to people. That means first of all, you have to deepen your access. Then you have to have innovative products, products which are suited not to the system, but the products which are suited to the requirements of the people. More often than not, this is always done from the supply side. So we need to look at demand side as to what exactly is happening. While we know precisely well what needs to be done, but the cost of credit remains very, very high, and that becomes a limiting vector.
The first point that you made in terms of customizing products for your target market. And I think some of us in microfinance are being able to do it successfully now. So I'll give you an example. We operate in 6 states. We operate in the eastern and the central part of India. And today we found that in Assam there is, because of the flooding situation, there is often very house damage happens for people who are financially excluded. So in partnership with one of the entities, with Magma HDI, we were able to develop what is called a Kacha Pakka product, which is a home insurance product on the group platform. When we went to Madhya Pradesh, we found the same product didn't have any takers because people have Pakka homes in Madhya Pradesh. But what they found is that they were never able to save enough for medical exigencies. And the HospiCash product is what found many takers over there. So I think it's finding the right customization of products for your target segments is very important as we move towards financial deepening. One of the constraints that we've seen in terms of making credit available to people who need capital, especially at that level, financially excluded households, is the cost of capital, the price at which they get money. And that is also evolving, I think, and I must say that I think that we've got, in the microfinance space, there are 2 SROs, self-regulatory organizations, which have done tremendous work the last 5 years. There's Sadhan and there's MFIN, which is enabling us to bring down the cost of capital. So, but even today, if you look at what we charge to our borrowers, our pricing ranges between 22 to 25%, which might sound criminal, but it's actually come down in the last couple of years. And the reason for that is the cost at which we get capital as a microfinance entity is anywhere between 13 to 15%. But that, as microfinance is getting recognized as a sector, and people are beginning to understand the whole business model, the cost of capital is coming down, and the beneficiary is the borrower who's been paying a high rate of interest, but it's coming down now.
Samastha.
Yeah, so just to further what you just heard, we are present at IIFL Finance. We are present in about 22 states. We cater to over 30 lakh borrowers across the length and breadth of the country. The truth is this, there are many hungry mouths out there, many hungry mouths over there. The need for credit is even more now than ever before. So there's a lot which can still be done. What's stopping us is exactly what you had said. The cost is actually quite high, or OPEX is actually increasing. The reasons are primarily to do with this. One, we at microfinance companies, in spite of all the digital transformation that we talk about, where all our disbursements of loan disbursements goes into the bank accounts of the customers, everything. We also encourage the repayments to be done largely through digital means. But having said that, to touch even a 10% of repayments through digital means is a Herculean task. What happens? We need to deploy feet on street. So when we have huge numbers of people, whilst the good side of it is that it provides employment. It provides huge employment to the people living in the villages and the tier 3 towns. But the flip side to it is, whilst these people are being employed, we've got to pay salaries. And salaries are not small. One of the reasons why the big banks, the regular banks, the universal banks, did not venture into microfinance is because of this aspect. Because the logistics of managing large manpower is quite Herculean. So the cost of salaries is high. Our credit cost also keeps increasing every time there is a calamity, because the population that we serve are a vulnerable set of population. They are the people who live at the bottom of the pyramid. If there is a demonetization, the people most affected are them. If there is a pandemic, though it is a black swan event, and both are black swan events, I hope, even then, the people most affected are the people at the bottom of the pyramid. And then there's always this unpredictable weather, unpredictable conditions of climate. You have a flood somewhere, you have a drought somewhere, you have a rainfall. And then what happens? It's this set of population whom we serve at the bottom of the pyramid who get financially impacted. And obviously, it becomes difficult for them to return the money in installments, however small the installments may be, on time. This affects the credit cost as well. Once these kind of things are addressed, I'm sure the costs can come down. And when the costs come down, we should be able to reach out to that many more number of borrowers out there, because once we reach to that many more number of borrowers, I'm sure the prosperity of the country can truly be seen to be real. Thank you.
I have a particular question for you. I just tell you a small anecdote. In the name of financial inclusion, we say that the credit has to reach out to people. So are these products, so that there are more and more people consuming it, quote unquote. There is an instance from Nilgiris where we were invited by a public sector bank that in a financial inclusion drive, a Toda tribe, which is living deeper into the Nilgiris, were to be financially included. So there was a camp. And people were brought over to that camp and accounts were opened. They didn't know what the hell are we getting into. So the net 5,000 rupees was put in everyone's account. So they did not know what to do with the money. They were not really comfortable, but we had to do a tick mark item. Over a period of time, those 5,000 rupees were consumed and they became indebted. So it was not given as a consumption credit, it was given as a credit. Meaning to say that when we are creating these products without giving them the capacity to absorb the credit, becomes a big question mark. You have cost as a problem, you have financial literacy, giving out credit to people so that they know how it is to be deployed, because for you, it is a productive money.
Yeah, definitely, this financial literacy is a continuous process. which simultaneously it has started with the financial inclusion project. So now all the entire public sector banks, including the regional rural banks, so they have been continuously educating all the customers through BC network, through specially engaged the senior retired staff members also, and this has been a continuous process, and we are creating awareness amongst the common people, especially those Jantan accounts which we have added. So this is a continuous process, and we are educating what is the importance of literacy, financial literacy as such. So this is happening, sir, already started.
Financial literacy is happening. So what has been the consumption ratio of the credit, which is what you have been offering? How it is leading to livelihoods? How is it leading to people's economic might improving? Or otherwise, how is it leading people to come out of the drudgery which is what they were in, and today are leading a life of dignity? So what has been the journey?
So this is definitely, all the Jandan accounts, they have been given an overdraft facility at the time of opening the account, but it was not properly understood in the beginning. But over a period of time, through literacy camps, it has been clearly explained to them that this facility is there, and over a period of time, once they avail a small credit of 5,000 or 10,000, and next time when they come, they can think of a economic activity, so that the habit of culture, the habit of repayment is inculcated into them. Yes.
So how many of such accounts are the first time borrower, second time borrower, third time borrower? So what's been the recovery rate? What's the NPA?
Recovery rate has been pretty good. There were no NPS as such, not much of NPS as such. But now whenever they are coming for the second time, the first time whatever they have taken, they were able to utilize it properly, and there were instances of second time and even third time also. But the percentage of those who have availed this overdraft facility is very, very less comparatively.
Okay. Lokeshji, if we refer to the recent reports, there is more credit than deposits. RBI also came up with this report that banks have given more, and there are less number of deposits. So that being the case, how is it impacting the cost?
Certainly it will impact the cost.
Take that.
Certainly it will impact the cost when your credits rate of the rate of increase in the credit is more than the rate of increase in the deposit, because more people are demanding credit, and lesser players are there in the market to offer the credit also. Certainly it will increase the cost, and it will increase the rate of interest on the credit. But what I want to suggest, that these players, since players are less players are there in the market, we have to increase. We have to think seriously to increase the number of players, means number of players who are offering the credit in the market. We have to increase seriously. More either public sector banks or private sector banks or NBFC or regional rural banks, whoever it is, number of players to be increased in the market. It is happening also due to the fact that we are not able to reach down the line up to the last people. Whenever you are not reaching down the line to the last people, money lenders will come in the picture, and they will be offering high rate of interest to the person who is asking for the credit. So it is required to increase this number of branches, number of institutions offering the credit, at least 500, per 100%. We are offering that BC network is there. BC network, they are accepting the deposit, but they are not extending the credit. They are receiving the deposit, opening the account, and paying them their money to them. They are not offering the credit. The application will come to the branches. Again, it will take time. The cumbersome process. Also, I want to say, process to be, why these microfinance institutions, they are offering, and people are ready to take at higher rate of interest from microfinance institutions. Why? It is due to the fact that their process are easy process are there. People are getting the money readily available from microfinance institutions. That is my suggestion. When you open more branches, more institutions, more branches, more products. Until unless you do this, this rate of interest will not come down. And secondly, you are asking why this deposit is, rate of increase deposit has gone down and rate of increase in the credit has gone up. You see CRR, SLR, you can see that one thing. RBI, now RBI, earlier the government were offering the deposit, government deposit to the institutions, now it is kept in the RBI also. You can see that. So that if those money were offering to the banks, were kept in the bank, earlier banks were extending credit against those deposit also. So demand is there, deposit demand is there, rate of credit increase is there, but last YOY, if you see, if you analyze the figure, deposit has increased with lesser speed than the speed of credit. Thank you, sir.
So this is impacting the deepening
and regarding
in a very, very negative way. How do we correct it? So panel,
No,
we have heard it.
one more thing I want to say, that you were saying that you were in the Nilgiri or somewhere you were quoting that 5,000 rupees were extended to 10, 20, 30 peoples. I will quote one live example. When I was in my early career, I was working one in tribal area in 2000 around 98, 99. And tribal area was there, and in those time accounts were opened with I think 5 rupees or 10 rupees.
10 rupees.
10 rupees only. And SAG concept was not there at that time. It was nascent, in one nascent stage. One, those areas we used to call lady Bai, respected lady as Bai. One Bai was working there, and some 4 or 5 Bai. My branch was rural branch, and 4 or 5 Bais were there. They were just discussing among themselves that वो लोग टोकरी बनाते हैं, बेचते हैं, और पैसा घर में कहीं रखते हैं, और उनके हस्बैंड निकालकर उसको मिसयूज करते हैं. They were discussing among themselves. I was standing nearby from 18 feet away. I was just listening. I was not able to understand, but I asked my sub staff what they were discussing. Sir, ऐसा है कि उनको वो लोग 10-20 रुपये इकट्ठे करते हैं और उनका पैसा उनको घर में मिसयूज होता है. So then I asked, just call them, I discussed with them, and by chance I talked to them, I visited the village and opened a joint account. I just go through the manual. At that time we were not opening any SAG, self-help group or 10 people or 20 people's account. Just I go through the manual and opened one account of 8 or 9 people, operated by 9 women, and operated by first 3 persons. All were putting their thumb impression.
Illiterate.
They were not literate. And you will not believe, we had just handhold them that they were bringing some bamboo sticks, preparing some tokeries, and selling in the local market hot, and whatever saving they were getting, after 6 months, one Mr. Khurana was there, heading the NABARD in the district. He visited, in meeting, he just talked to me. So I told him that, sir, I have just opened one this. What is this location? This. Then he told, you have done a fantastic thing. This is one SHG you have opened. 6 months. And just that people use that money as consumption, understanding that this has been created in their account to consume, we have to handhold them.
See,
handhold is required.
You hit the nail right on its head. When
Yes.
you said that the money was given to them because you saw how they can deploy that money, convert it into a livelihood. So that capacity to convert that money into livelihood, you saw that's how you only lent. But my example was that you were doing
Simply
financial
credit
inclusion. That give inclusion, do a tick mark, open an account, whether or not they live or die thereafter. I share a similar example with you. This is from Kalahandi. Early 2000, and this was an intervention done by State Bank of India. Everyone knows Kalahandi, known for starvation deaths. And I've myself been a witness to the worst that one can, a lady picking up food from the same vessel in a garbage dump along with a dog. So both were eating together. So this was really, really a sad situation. After the bank's intervention, The first what they did, they promoted the rural artisan and converted into their livelihood. So they are good in handicraft and bamboo, which is what they promoted. And then they gave them the credit, they gave a livelihood linkage, and then products started selling in the market. So that was the transformation that happened in Kalahandi. Today, that's one place wherein the district GDP indicators have really, really improved. Although we don't capture GDP at the district level, but if you look at the socio-economic development, that has really, really improved. But that brings us back to the same discussion. While it is very good policy to have, but it may not be good politics. So coming back to you, this cost has become, the increase in cost as a result of imbalance between credit and deposit. How are you going to handle it?
So I think the answer to this is, no matter where you operate as an NBFC, MFI entity, you've got to look at leveraging technology better. So digitization, and a mention was made that in spite of our best efforts, digital collection even today does not cross 10%. We've done slightly better than that. We've been able to take it to 20%. But leveraging technology or digitization can be looked at in many different aspects, even in our world in microfinance. You can leverage eKYC when you're sourcing a borrower. Then in the whole sanctioning process, you can look at paperless flow of documents. You can then look at collections. In the whole collection framework, how do you do digital collections? And then again, in your cash management, how can you use technology a lot better? So one of the advantages of digitizing more is that the productivity of your frontline goes up dramatically. So the proven model in microfinance is that a frontline can handle about 600 to 800 borrowers if you're working with a monthly collection model. But the minute you can bring in digitization and whether it's sourcing or it's collections, you can digitize some of these processes. You can actually take that number up to 1100 or 1200. So that's a 40% betterment that you can do in the productivity of your sales person. Where do you get that benefit? One of the biggest costs in our business is your operating expenses. So our cost is about, we typically charge about 24% to a borrower, but that is also because our operating expenses are very high, they're almost 7%. But by leveraging technology, your OPEX can actually be brought down to 4%. And which is where you can then pass on that benefit to the borrower. You can bring that cost down to 21%. The other avenues, in your overall pricing, there's also credit costs that you factor in. But again, like I mentioned, thanks to the work that the SROs have done, and there's some bureaus which have been created. There's an employee bureau for hiring in microfinance. There's a credit bureau also separately for microfinance. If you leverage some of these platforms better, you can also bring down your credit cost. Through the employee bureau, you can ensure that you've only got the right integrity employees coming in. And if you leverage the credit bureau, then you can ensure that you're only giving money to a quality borrower. So I think these are the aspects that one should look at. Leverage technology in all your processes in the business. And the second is leverage the platforms which have been created, whether it's a credit bureau or an employee bureau, to bring down your credit cost.
Yeah, just so that we haven't completely digressed from what the question initially was, with the rate of deposits not keeping in pace with the rate of credit. The truth is this, for credit to grow, we have any number of institutions, like how you rightly pointed out, microfinance companies included. What is also to be noted is that NBFC MFIs cannot play an active role in garnering deposits. As per statutory regulations, NBFC MFIs cannot play the role of garnering deposits. So as if you're talking about, if there are that many number of people out there in the field to take care of one facet of this financial deepening indicator, the other important aspect of deposit mobilization, if that also can be utilized, can be done by the people who are already there at the customer's place offering credit, then I think to a great extent that imbalance can be taken care of. And as a result of taking care of that imbalance, cost can come down as well, in addition to having digital transformation taking place continuously. Another important aspect with regards to this classic example of how money could be used for consumption purposes and not for income generating purposes. Most microfinance companies, and mine included, what happens is that we have something called a loan utilization check. So the moment a loan is given away to a customer, to a borrower, in spite of providing financial literacy, and only after providing financial literacy do we offer a loan. And after doing that as well, there can be slips. There can be some pressing demands when the customer chooses to use it for consumption purposes, not for income generating purposes. It is at that time that it's necessary for this loan officer to go to the customer's place to find out if the money that was lent was used for an income generating activity or for a consumption purpose. So with these checks and balances in place, and if we further that even more, I think we'll be able to address the situation. Thank you.
Mr. Reddy.
This turbulence between the deposit growth and credit growth, that has not been even throughout the country. So it differs from northern part to the southern part. If you go to the down south, the credit growth is much more than the deposit growth. On the other hand, if you look at the northern areas where the credit growth is lesser than the deposit growth. So obviously, there is still, we have a lot of informal savings available in the, with the people, more so in the northern side. So there are still many unbanked areas, unbanked rural areas are there. So there is a necessity for improving our network so that we can bring the informal savings into the formal system. That is one way where we can bring in additional deposits into that, especially the low-cost deposits, and so that once it comes into the formal system, then the equilibrium will take place. And this is a cycle. Sometimes for some period there will be a deposit growth at a higher rate. So for some period there will be a credit growth higher. So this is only a life cycle which replicates. So I think there is a definitely requirement for opening up more outlets in the unbanked area so that the informal savings can come into the formal system.
I don't think you will agree with him.
No, some part I agree, some part also I disagree. But your question, you are asking that the credit has increased, rate of credit has increased with respect to the rate of credit, deposit increase. But this year it has happened. This year it has happened. 2024, whatever results have declared by the, or figures have come out, it has YOY, it has been seen, observed. But if you observe credit deposit ratio, it is still hovering around at 70 to 80%. It is hovering around 70 to 80%. Some banks have got at 80%, some have got at 70%. The credit deposit ratio has not increased more than 100%. Then it will be a serious situation. But this year, YOY, in the June, whatever results have come out, deposit growth is less than the credit growth. I agree. But this is not a situation that why this has happened. If you ask some pundits, they will say that people are investing in mutual funds, a stock market, bonds, SGB, PPF. People are getting good returns in the SCS or government, whatever products government is offering, people are getting their returns, or in mutual fund. Mutual fund has picked up. But this is I agree with him that this is a particular phase where this has happened. Going forward, nothing going to replace these deposits or liability side or liability products offered by the banks or financial institutions. Whatever products offered by the banks, financial institutions, people are coming, but rate of increase of deposit have come down. Only due to the fact that some better products are offered, some better returns are being offered in the market. It may be mutual fund, it may be other products also. But again, I will reiterate that CD ratio is hovering around 80% only. It has not gone, it is 70% to 80%. It has not gone more than 100%. It is hovering around 70% to 80%. And any question?
I will come back. Definitely more questions there.
All that I want to add is that the household savings in India stands at around 30% of GDP, sir. So that is the only point that I wanted to make.
Yeah.
Thank you.
So, in fact, while on CD, he has clarified, and he's also said that, it may be, it's actually lopsided. North India is probably lending more South India is absorbing more.
South of
Yeah,
lending.
the South is lending more, so it's lopsided. So at the end of the day, it's 70 to 80%. But the point is, when it comes to financial deepening, it's not only about lending or credit, it's also about these suitable products from where we started the discussion. So a big question mark remains, do we have suitable products? And if I go back to the house and ask you, he's talking about mutual fund, of course. I also talked about mutual funds and the pocket-friendly investments. If I may ask you, how many of you have stock market exposure in equities? Let's see the hands going up. Less than 20. Less than 20. So that means out of 150 people here, only about 20 hands going up, and we are all calling ourselves educated, informed, and having the capacity to invest. If I say mutual funds, how many of you?
Each and every one.
Not each and every one. You'll see just half of the house. Still, so that means to say that remains a big challenge. If we are not able to penetrate to this strata of the society, how do we reach out to people and really say that whatever products we make, that means to say we are not creating pocket-friendly micro products and reaching out to people, which is the need of the hour. We are only doing lending and credit. We are not moving beyond it. Sir, I'll come back to you. We will have questions. So anything from the house you would like to submit to this?
So I had mentioned, I think financial deepening has got 4 pillars to it. First one is your savings and transacting capability, so which gets covered through your liability or deposit products. The second is your financial goal planning, which is investments where shares or mutual funds come in. Third is providing credit, which is the lending businesses. The last is risk mitigation, which you provide through your insurance products. Overall, we are making progress on 2 of these pillars in terms of the liability business or deposit generation and the credit business. The other 2, there is a greater amount of awareness which needs to come in. And risk mitigation, again, if you look at the number of products that we've got on offer today, whether you look at life insurance, general insurance, health insurance, I think we've got one of the best product offerings in the country today if you compare it with other markets. But that awareness needs to go up in terms of how risk mitigation can play a big role in one's financial well-being. The second is a better understanding on how equities or some of these other asset classes can play out in terms of financial well-being or financial goal
I'm
plan.
sorry to interrupt you. You said it. The risk products on a scale of 1 to 4 is number 4. The question to ask is why we do not believe in covering risk. Because of 2 reasons. A, after going first, second, and third, there's hardly any money left in my pocket to cover the risk. Why? Because every other product is expensive. Fourth is, risk I say, aaj nahi hoga, kal hoga. I always postpone all medical emergencies, I postpone life emergencies, I postpone all kind of health emergencies. Saying it's not going to happen to me, it's going to happen to my neighbor. And third point is that insurance in India, of whichever kind, general, life, health, whatever, insurance in India is taken still as an investment product. It is not used as a risk cover. So till such time that happens, this is where the point he's trying to make, that we need to make people aware. Since 1991, we have come a long way and we are still making people aware. Still the financial deepening is a truth which is looming large to happen. So it's a big question mark, how do we really address this issue? Yeah.
Definitely, especially the public sector bank space is the major public sector. There was not much of an idea about the investment side, and maybe I think probably more than 10 years over now, we started stabilized our the insurance side. We have partnered with so many insurance partners. Now we started doing comfortably. Of late, I think from 2022 onwards, our entire banking industry has realized the importance of wealth management. Now, apart from our routine business, separate verticals, all the public sector banks, they have come out with a wealth management vertical. Whenever there is a shortage of the expertise, all these banks have taken the people from the market, and all the banks have started educating their customers through the wealth management vertical, and this is going to be a game changer.
Sorry to interrupt you here again about wealth management. It is something very elitist. Let's take it. Because all these wealth managers, they will not go to category C and category D towns or in villages in the name of creating wealth for anyone. So this remains more of an urban concept. If it was not for the public sector banks who had the mandate to do development banking only, which later on came to be known as financial inclusion, India would have remained financially excluded. So credit goes to the public sector banks. There is no denying the fact. And there are institutions which are built over and above the capacity which was created by the banking system, so that MFIs, NBFCs and other institutions also do a deeper penetration where I have not been able to fly. So there is a difference between an Air India which goes to the nook and corner of the country, and in comparison to a profit-making airline which will refuse to fly in those areas. So it's fantastic. I mean, you want to say something on this?
Just to reiterate, again, the reason I posed the question on the rate of premium. So the risk is so very, the part of it is left behind. You pay for your school fees, you pay for your rentals, you pay for the milkman, and there's hardly anything left. And in that scenario, the rate of premium that you charge for a pure life insurance, unless that keeps coming down, unless that becomes really affordable, alongside with creating awareness, then we will forever be playing the risk of aaj nahi hoga, kal hoga. So that's important.
True.